Good evening, class. Welcome to our MI class. Today, we'll be discussing a particular topic that is so important in the understanding of marginal costing. In a moment, let me share my screen so that you can see the topic under discussion. The topic under discussion here is relevant cost analysis. Relevant cost analysis is a topic that you must understand before you can make headway with marginal costing. Now let me go on with the rules for the class. Of course, you are on mute, both your video and your audio. You should not try to start your audio or your video because it's going to distract the class. And I'm happy that you are keeping up with that. Also, if you have any question, you can take a jotter at this moment to write them down, because I believe that your questions as they come would have been addressed in this topic. But if none of them are addressed here, you can then put your question in the chat. I will take some time to look at the chat and address your question. Okay, let's go straight now to the topic for today, relevant cost analysis. Relevant cost analysis is important in short-term decision making, such as limiting factor decisions. You see, the last topic I taught you was limiting factor decision. You will need relevant costing analysis to be able to really understand that. Also, we have make or buy decisions, which is something you will learn soon, and shut down decisions. Costs that are relevant to decision making, we call this cost marginal cost. We also call them variable costs. When we talked about cost classification, we mentioned the behavior of costs to be either variable or fixed. Today, we want to see how we can analyze our costs to see if they are relevant in decision making and how we plan to take these decisions. So let's just look at relevant costs versus non-relevant costs. This distinction is very important in understanding this topic, because if you don't know what a relevant cost is, then you cannot apply that cost in marginal costing or in making decisions. So which costs are relevant? The first one on the list here is variable costs. Variable costs are incurred with varying level of activity. Now, what it means is that if you do nothing, you spend nothing. If you do 1 unit, the cost you are going to spend is proportional to 1 unit. If you do 100 units, a proportionate cost equal to 100 units would have been spent. So your variable cost spent is directly proportional to your level of activity. So variable costs are relevant. So if your decision tells you that you should make 100 units of a production, you spend a particular cost. Now, if it tells you make 200 units, your costs are going to increase. So this will affect your decision. So variable costs are important. The next one we want to talk about is the opportunity cost. What are opportunity costs? These are cost of alternatives that are foregone. For example, the opportunity cost for you to attend this lecture here in Zoom is what you have foregone. Perhaps you've foregone watching TV, playing games, chatting on the internet, reading a book, or even going to see someone. All these are things that you have foregone that should have taken your time now, but you are here in this lecture. So if you can quantify these things that you have foregone in monetary terms, then that is your opportunity cost. When we are in economics class, we were told to arrange all our priorities, all our needs also in order of priority. And so the opportunity cost of doing the item on the number one list is the item on the number two list. Because if you are not doing the number one list, you would have been doing the number two. So the number two list item becomes the opportunity cost for doing the item in number one. So you could have decided to do all of this, but you said, no, I'm going to deny myself the opportunity cost. Third one is incremental cost. What is incremental cost? Incremental cost will now have to do with fixed costs, because of course we cannot say we can say that variable costs are incremental in nature. Yes, because if you are doing an item, if you are doing production for 10 units, you spend money proportional to 10 units. When you are doing 20 units, you are spending money proportional to 20 units. So the increase from 10 to 20 is an incremental cost. It happens every time in variable costs. But when it comes to fixed cost, it doesn't happen that way most times. For example, the fixed cost of using a particular item, let's say I hired a classroom that can take only 50 students. Now, whether there only one student, like you are only here, you are the only one here taking this class, fine. It will not make any difference how much I'm going to pay for the class. If there are 10 students here, 20 students, it doesn't matter. My fixed cost is the same. Now, what if the class is filled to brim, 50 students? I will spend the same thing. But what happens when I now get 60 students or perhaps 70 students? Now, that would mean that they cannot be contained in the class. It will mean that I may have to divide the class into two sessions. And if I'm paying the fixed cost according to how many hours I use, it means that I am going to spend additional fixed costs. And that additional fixed cost is the incremental fixed cost. And so when you are spending fixed costs above what is usually budgeted, then that's incremental fixed cost. The next one is future costs. What is future costs? Any cost that you will likely pay in the future. That means that any cost that you spend already is not relevant. Any cost that you will spend is relevant. So you have to look at it this way. Any cost item that goes with the past tense, then it's not future cost. Any cost item that goes with the future tense, then that is a future cost. For example, cost proposed are future costs, but cost spent are not. If you say, I will pay my ICANN tuition fee or my ICANN exam fee from my next month's salary. Now that's future cost that you've just budgeted. So anything that you plan to do in the future, any cost you plan to incur in the future, it's relevant. You do not take decision on something that is past. You take decision to do something in the future. Then the next one we are going to talk about is the avoidable costs. What are avoidable costs? Avoidable costs are those costs that you can avoid if you have the opportunity to avoid. So let us look at which costs can be classified as avoidable costs. We see that variable costs can be avoided. This is because if you do nothing, you spend nothing. And so variable costs can be avoided. You can avoid spending variable cost on 1,000 units of goods when you can do 10 units of goods. So the difference of 90 units, cost spent on them could have been avoided. So anything that you can avoid is relevant. Now we've seen that you can avoid relevant costs. Can we avoid incremental costs? Yes, we can. We can avoid incremental costs by not taking any increase. So when we don't take any more increase, when we see that it's reached the brim, we stop. It's just like our WhatsApp group. Assuming we are paying for WhatsApp group and it is 257. And when we have 257 and we say no more, then we can avoid the costs associated with having more people in it. But if we say, okay, we want to create additional classroom for MI2 or MI3, that means we have not avoided it. It's not as if we cannot avoid it. We can avoid it, but we deliberately choose to ignore it. And so that makes it a relevant cost because there is the option that you can avoid it. What about opportunity costs? Opportunity costs are cost of item forgone. So you can avoid them by refusing to let them go. So you can avoid paying for ICANN exam by using the money to go and watch film, if that's your priority. You can avoid attending this class by not paying and use the money for something the alternative item that takes precedence. So that would mean that this class that you have forgone, which is the avoided cost, becomes an opportunity cost to the new item that you have used the money on. So we've seen that incremental costs are avoidable costs, opportunity costs, and variable costs. What about future costs? Are they avoided? Yes, you can avoid them because they are made, they are going to be spent in the future. You can decide one day not to spend it. The money is still with you. You can decide that you are not going ahead with it. You have aborted the plan. And so future costs not spent already, avoidable costs. All of these can be referred to as relevant costs. So we've mentioned 5 things that we can know a relevant cost. We can see that anything that is variable in nature, variable cost, relevant. Opportunity cost, relevant. Incremental cost, relevant. Future cost, relevant. Avoidable cost, relevant. So your exam, if they want to tell you about relevant cost, you have to look at these things and you'll be asking yourself, this cost item that is given to me, is it presented in the future tense? Then it qualifies. Is it a variable cost? Then it qualifies. If I decide not to do it, is it possible? Then it's an avoidable cost. So all of these can be seen as relevant costs. Let's look at the non-relevant cost here. We have fixed cost absorbed. Now, can you see the word absorbed? That's written in past tense. Now, fixed cost absorbed is so because we use what we call overhead absorption rate. We use overhead absorption rate, which is predetermined in the past, and we are using it to calculate on a budget based on experience in the past. And so any fixed cost we absorb, it doesn't matter whether it is the actual fixed cost or not. We have absorbed it, it becomes irrelevant. Fixed cost that is already absorbed in your production is irrelevant. For example, your rent you pay has been absorbed in your production, so it is irrelevant anymore. The next one is sunk cost. Sunk cost is technically cost made in the past. And so anything that has past tense, cost made in the past, does not have a bearing on the future and does not have to be relevant. That's why when we are making decisions, we don't use the historical cost of material to make decision because it's already in the past. After all, how much you buy a particular bag of flour 2 or 3 months ago, the price may change now. And if you are basing your decision based on how much you buy it in the past, then it's wrong. Let's say, for example, you buy a bag of rice, 10,000 naira 3 months ago, and it's still in your store. And you learn today that bag of rice is 18,000 naira in the market. And that is how much you are selling it now. Will you say because, oh, I bought it for 15,000, let me sell it for 18,000, and I'll take the 18,000 to go and buy another bag of rice? No. If the bag of rice is still good and intact, you sell it at current market price. Why are you selling it at current market price? Because the cost price that you find out that the current market price has changed. And so you're not relying your information based on sunk costs. The next one is committed costs. What are committed costs? Committed cost has two elements. One, it will be spent in the future. Now, because you are spending this committed cost in the future, does it make it a future cost? No, it doesn't make it a future cost. It is treated like a sunk cost because of the commitment that you made on that cost element. Let's take, for example, you are being paid 100,000 naira every month. Example. And ICAN exam, you are going to pay maybe 50,000 naira for the number of papers you are going to write, for example. Now, you told yourself that I will use my June salary or perhaps my May salary to pay for my July 2020 exam. That means I'm going to take 50,000 out of it. Now, because you are saying I will, it's a future cost, right? But because you've made a commitment, is your salary to you is no longer 100,000. You are now looking at 50,000. So whatever you are planning with 50,000 because 50,000 has already been committed for ICAN exam. So the other 50,000 is what you'll be planning with. These are what you base your decisions on, not on the whole 100,000. So you see that committed costs are looked as if it is paid in the past. And so it is not relevant to your decision. The next one is non-cash flow. Any cost that does not involve the movement of cash is not a relevant cost. For example, is depreciation. What is depreciation? Depreciation is wear and tear from use of an item. And so if you buy a phone, let's say for 100,000, and you use it for 1 year, you find out that the phone value would have been reduced by 30–40%. Now, does it mean that you've spent money? You've not. You've not lose 30–40% of your money physically, but you lose the value of that money, because if you want to sell it again, you have to sell it at less than the amount you buy it because of this depreciation. So depreciation is not a physical cash leaving your company. Although depreciation is seen in financial accounting as expenses and there is a value to it, these are not real cash. It's just like saying profit. Profit is just a jargon that says your sales revenue minus your costs. There may be no cash involved. Yes, let's say you buy the goods on credit, you didn't pay cash. And you sold your goods on credit, you didn't collect cash. You've made profit, but you have not collected cash, you've not spent cash. And so anything that does not involve the use of cash is not a relevant cost. Then we have unavoidable costs. So unavoidable costs are costs that you will spend whether you take that decision or not. So irrespective of whether you are making the decision or not, you are going to spend that cost. Let me give you an example. If you are choosing a center where you will attend lectures, now you may want to consider transport. How much with my transport fare? So transport fare becomes a kind of variable cost. If you attend a center that is very near to you, you might not spend transport. Fine. If you attend any place further than that place, you may spend maybe 100 naira for transport. You say it's fair. What if you start spending 500? So you see, it is an item that will make you to decide. So you start counting. If I spend 500 naira going, 500 naira coming, for how many days? Wow. So you see, transportation, the higher the distance, the higher your transport, it affects your decision. Now, when you are making this choice of a tuition center to attend, can you be considering feeding? Feeding is like a fixed cost. So whether you attend the one that is in your house or the one that is not far that you spend 100 naira, or the one that you spend 500 naira, you will still feed. You will still spend the same amount of money you are spending on feeding. Whether you decide not to attend any tutorial classes, you will still feed. So irrespective of the decision you take, feeding is still unavoidable. So that's how unavoidable costs work. Now we've seen five types of relevant costs, 5 types of non-relevant costs. So in your exam, all you need to do is to look at the cost critically. And when you look at this cost critically, you have to say these costs are relevant. These are not relevant. So you start marking them off if they are relevant or not relevant. So that's how you will deal with a question that has to do with relevant costing. Now let's look at some guiding principles that can help us to understand relevant costs. We are going to be discussing relevant cost of material and relevant cost of labor. Now, why are we discussing relevant cost of material and that of labor? This is the reason. Variable costs are relevant. Non-variable costs like fixed costs are not relevant. Now, if you look at relevant variable costs, there are two classic elements that forms variable costs. We have materials, we have labor. And so if variable costs are unavoided, they are relevant, then it is best we discuss relevant cost of materials and that of labor. Let's take them in turns. In order to determine which material cost is relevant, we need to ask ourselves a yes or no question in order to determine their relevance. The questions are, is the material available in stock? Okay, let me show you the chart down here. We use the chart to, it's the same thing here. The chart here is the same thing. The first thing is to ask yourself, is the material available in stock? So you see here that I underline the word available. So availability of the material is the first consideration. What if the material is available in stock? You see the arrow pointing down here, that you should move to the next question. So this is one option. So you have an option to make. That's why it is relevant. So you have an option to make. Assuming it is not available in stock, that means you want to make cake or bread and you need flour, and you go to the store and you see that there is no flour in the store. What do you need to do? You need to go and buy the flour at the current purchase cost. So you don't look at it and say, how much did I buy it last time? How much did you buy it last time may change, except if it doesn't change, then fine. If it changes, what you should be considering is how much is it being sold in the market as at now. That is the current market or purchase cost. So if the material is not available in stock, this is relevant. So that amount, the cost here multiplied by the amount you need, is your relevant cost. Now, what if it is available in store? Say, go to the next question. The materials that are available in stock, are they in constant use? Now, what it means is that if you do not use it, will somebody else be using it? Or do we use it every day? Is it very, very important that we use it every day? So if you are working in a factory where they make bread, you find out that flour is being used constantly. And so if you are doing a one-off contract for somebody, if you are trying to convert the use of flour for bread, and you want to throw a party and use it for cake, so you ask yourself, are we using this material constantly? If it is yes, that means anything you take, any quantity you take that you require, you must replace them. You must replace it because they will use it again. And so just like the purchase cost currently, this is replacement cost. Both current purchasing cost and current replacement cost could be the same amount, because technically here, when we say it is not available in stock, we cannot call it replacement because it is not available before. We are buying it afresh. But now it is available here, and we have taken whatever was available. We are replacing it back. So the purchase cost here and the replacement cost here could be the same figure, but the technical term here is replacing when you take something. But when something is not there, you are purchasing it anew. Now, if it is not in constant use, that means if I take this flour and do bread, and do cake. They don't use it constantly now. So there's no need for you to call for replacement. So you just move to the next question to see the next consideration. The consideration here says, if the stock of materials are not in constant use by the company, does it mean that it is scarce in supply? So why are we not using this thing constantly? Could it be it is scarce in supply? Yes, if it is scarce in supply, that means opportunity cost is important because that material is important. So when something is scarce, that there is an importance attached to it. That means some items will be competing for the use of that resource. So you have to find out that if you don't use it to do cake, you can use it to do any other thing. Opportunity cost is important. Now, if it is not scarce, now consider it now. It is available in a store, but you don't use it constantly, and it is not scarce. If you don't use it for what you want to do with it now, you may have to dispose it because after some time it may expire and you may need to dispose. Or if it is maybe toxic, you may need to spend money to dispose it. And so your disposal cost becomes your relevant cost. What if you don't dispose it? What if you say, okay, if I take this flour now, nobody's going to miss it. Nobody is using it. It is just there in the store. What is the relevant cost? It is nil because you are not purchasing it anew, you are not replacing it, and you are not thinking about the historic cost. There is no opportunity cost that you are foregoing as a result of using it. So by using it, it is a nil value. So when there is no scarce supply of that material, it becomes nil, except if there is going to be disposal, then you say disposal costs. So that's all what this analysis here is trying to explain to us. Let's look at one question to talk about material costs. Let's look at ROC01. Grace Chika Limited has been asked to quote a price for a one-off contract. So how do you know a question is relevant costs? Apart from looking at the required, identify the relevant costs of the materials to assist management. Apart from this, once you see the word one-off contracts, it's a signal that you are dealing with relevant cost question. Now, the contract will require 5,000 kilograms of material K. Material K is used regularly by the company. The company has 4,000 kg or kilogram of material currently in inventory, which costs 400 naira per kilogram. Okay, let me exercise a little patience for the student to send back in. Okay, I can see that you are now in here. All right, so Grace Chika Limited has been asked to quote a price for a one-off contract. And I said, by saying the word one-off contract, it is it is a sign that it is relevant cost. The contract will require 5,000 kilogram of material K. So what is in consideration here is material K. And we are told that material K is used regularly by the company. The company has 4,000 kilogram of material K currently in inventory, which costs 400 naira per kilogram. The price for material K has since risen to 420 per kilogram. The contract will also require 2,000 kilogram of material Q. There are 1,500 kilograms of material Q in our inventory, but because of a decision taken several weeks ago, the material Q is no longer in use by the company. The 1,500 kilograms originally cost 144,000 and have a scrap value of 36,000. New purchases of material Q would cost 100 naira per kilogram. Required, identify the relevant cost of the materials to assist management to get a minimum price to charge for the contract. That is our question. Let's go and see the solution. Okay. Now here comes the solution. Now I want us to be looking at the question and be looking at the solution at the same time. So relevant cost of material. For material K, we are asking the first question. We first of all look at it that this contract would require 5,000 kilogram of material K. So we ask ourselves, is the 5,000 kilogram required materials available in stock? Let's see. We are told that the company has 4,000 kilogram of the material in inventory. So answer we will give here is the contract needs 5,000 kg. However, 4,000 kg are available in stock. That means that 1,000 kg are not available. It means that we shall make a purchase of the deficient 1,000 kg at the current purchase price of 420. How do we know that price? We are told that the current 4,000 kg in inventory cost 400 naira. So this is a sunk cost. They now said the price for the material has since risen to 420. So this is more relevant because this is the current price. So we now say we will buy the 1,000 that is remaining, new fresh purchase at 420. The second part says the 4,000, because now we have taken care of 1,000. 1,000 is not available in stock. We are going to go and buy 4,000. That means 4,000 are available in stock. And so because our theory says when they are available in stock, we are going to ask the next question. We ask the next question. The 4,000 in stock, are they in constant use by the company? See what the company says about it here. It says material K is used regularly by the company. So if material K is used regularly by the company, it means that it is in constant use. Yes, it is used regularly in constant use. That means the 4,000 kg, if used in the contract, because it is in constant use, we will have to replace it. You want 5,000? Fine. The 4,000 that is available, if you take it, you will still need to buy and replace because we are using it constantly. And so you buy it at the current replacement price of 420. So you can see that you have dealt with the 1,000 and the 4,000. So that means you've dealt with the whole 5,000. The third question is irrelevant since this particular question relates to materials that are not in constant use by the company, and the material in this question is in constant use. Normally, when we ask question number 3, it is because it is not in constant use. And we say, no, ask the next question. But now, the 400 kg is in constant use, and we've said we are going to replace it. So question number 3 doesn't hold anymore. So all we have left is question number 1, availability. Only 4,000 is available. 1,000 is not. That 1,000 has to be purchased specially. The 4,000 that is available goes through a second test. Is it in constant use? If it is yes, fine, you replace. If it is no, which this question is telling you that it is yes, if it is no, you go to the next question. So we don't go to the next question because our question here, 4,000 units are in constant use. So look at the relevant cost here. The relevant cost of the material K are, look at the replacement cost of 4,000 units. At 420 naira, that 420 naira is called replacement cost. It's called the replacement cost. Now, the additional purchase of 1,000 kg at 420, this 420 is called the current market price. So you see, this 420 here is replacement cost. For how many? You are replacing 4,000. That's why this 420 is replacement cost. You cannot replace 1,000 because you went to buy extra 1,000, so you are purchasing 1,000 new. So you call this one current market price. So when you multiply it, you get these figures here: 1,680,000 and 420,000. You add them together, you are having 2,100,000. That's for material K. I believe it's clear. Let's go to material Q and let's see how different it is. Is material Q available in stock? Let's see what the question says. This contract will require 2,000 kilograms of material Q. So we ask, is the 2,000 kilogram available in the store? What's our answer? There are 1,500 kilograms of material Q in the inventory. So what do we process from this? We say, however, 1,500 kg are available in stock. It means that 500 is not available. It means we shall make additional purchase of 500 units at the current market price. And what's the current market price here? You open your question. The current market price, you said new purchases of Q would cost 100 naira per kilogram. So your current market price is 100 naira. So 100 naira per kilogram. So you go to the next question. Now that you have identified that 500 are not available, that you need to specially go and buy it, you've agreed that 500 kg multiplied by 100, which is the purchase price, will be your relevant cost for the 500 units. Let's deal with the remaining 15 that are available. It says here, Okay, the next question is the 1,500 that are in stock, are they in constant use by the company? So let's see what it says here. The 1,500, okay, they said because of a decision taken several weeks ago, material Q is no longer in regular use by the company. So if it is no longer in regular use by the company, it means it is not in constant use. If it was in constant use, it means when you take that 1.5, you are duty bound to replace it. But now it is not in constant use. You ask the next question. So what's the next question? If the stock of 1,500 kg are not in constant use by the company, does it mean that it is scarce? Okay, look at the answer. The answer says no. The company stopped using it as a matter of policy, not because of its scarcity. However, there are alternative opportunity costs. Let's see. How do we know there's alternative opportunity costs? Question here says the 1,500 kg originally cost 144,000 and have a scrap value of 36,000. So it means if you don't use this material for what one-off contract that you want to do, there's a possibility you sell them for scrap. So the opportunity cost of using this material for your one-off contract is that scrap value that you are going to miss. So that's your opportunity cost. So we look at the answer here. It says, hence the opportunity cost is the relevant cost. So how do we calculate the relevant cost of material Q? The first one is the additional purchase of 500 kg at 100 naira, and we got the market price for the relevant cost as 50,000. Then we say opportunity cost. The opportunity cost is from the sunk cost, because if you're not using your cost now, you're going to use it by disposing it for scrap at 36,000 naira. So that's your opportunity cost. So when you add 50,000 to 36,000, all you get is 86,000 naira. So that's your relevant cost for material Q. So you will now bring them together. Your total relevant cost will be relevant cost of material K plus relevant cost of material Q. You add them together, you have 22,186,000. So that's your relevant cost of material. So you see that that's questions we keep asking in that our flow charts is important. It's good to ask them in that order. First, you think about availability. That's the first thing you think. After availability, you think about the constancy. After this constancy, you think about the scarcity. So the scarcity will now bring the need for opportunity cost or for disposal. Now that we've seen material, let's look at labor. Relevant costs of direct labor. Now, in order to determine which labor cost is relevant, we need to also ask a yes or no question. So this is like a yes or no question in the exam. So what are those questions? Look at the diagram I'm going to show you here now, similar to what we considered in the first one. But note the difference. It says here, is the labor that is available, is it in permanent employment What do we mean by permanent employment? It means that you are a permanent staff. You go to work every day, and you don't go to work only when there is a contract. You are already in employment. They pay you salary, a fixed guaranteed sum, a salary, and so you are in permanent employment. These days, most contract staff can be seen as permanent employees because they don't pay them wages. So anybody you pay wages, that is the person not in permanent employment. So when it is that there is no permanent employment in the direct labor, what it means is that if you want to get a project done and you require a certain amount of manpower, man hours, and you look inward, do we have them available in permanent employment already? And your answer was no. It means you have to go and recruit specially for that job, which is avoidable. You have to recruit specially for that job. And when you recruit workers for that job, you have to pay them hourly rates. So any amount they charge you per hour is what you will pay for the number of hours they spend on the project. Now, assuming that the people who are going to do the job, they have the skills, expertise, they are already in employment, fine, you move to the next question. Now, what is the next question? The question is the permanent labor that is available. Do they have spare capacity? Now, how do we know that labor has spare capacity? One, if you are not working every time you go to work, that means you have capacity. What can you say of someone who goes to work and is operating WhatsApp when he's supposed to be working? That means he has spare time to do WhatsApp. Or you play video game. That means at your spare time, you are indulging in this. If you are working, like in the bank, most people will stay in the morning till evening. They will not even know that they've eaten or they have not eaten. They are working, busy doing one thing or the other. Then you don't have spare capacity. Note, your break time is not your spare capacity. So some people will say, okay, I can spare my break time. No, you can't be working during your break. So you don't include your break time. So if there is no spare capacity, you move to the next question. But if there is a spare capacity, the relevant cost is zero. Do you know why it is zero? Do you know why when it is having no spare capacity, when it is having spare capacity, it is zero? This is because of this permanent employment here are currently in employment. They are paying them a fixed salary. So what happens is that you are paid to work 9 to 6 or 9 to 5. Let's say 9 to 6, which is like 9 hours. If you are paid to work 9 hours, your salary will not be reduced whether you work 6 hours. Okay, the students have gone. Let me hold on a moment for the student to rejoin. Let me hold on a moment for the student to rejoin. Okay. We wait for the audio of the student to come back. Perhaps it's network. Fine. Means you can hear me now. Now I was explaining about why is it that when the labor that is available have a spare capacity that the relevant cost is nil. This is because they are already in permanent employment. That is why we move to the next question. And they have time in their hands. That time has been paid for when they pay them salary. Unlike these people that they will be currently recruited, and they will be paid hourly. You don't pay permanent laborers hourly. You pay them a guaranteed amount. So that means even those that stayed at home and did not come to work because of COVID-19, even those who are pregnant or who give birth and are having maternity leave and they're not actively working, because they are permanent employees, they have spare capacity, but you are paying them. When you see that a laborer has spare capacity, what should come to your mind is permanent employment. Because if you are employed temporarily, you will not be talking about capacity or spare capacity, because it is what you work that you will be paid for. So if you sit down and say, okay, I have time in my hands, you don't have time in your hands. What you have just done, you've just decided that you don't want to be paid for that time. But a permanent employee can decide to play games with his time and delay the job in his office. He has spare capacity. Or it may be that he is not deliberately doing it. He has finished his job for the day and he has spare capacity. And so let's look at it that you go to the work by 9 o'clock, you are so busy, and that by 2 p.m. you finished your work and you have time to play game. Your boss now said, okay, we have this one-off contract that we want you to do. Please go and join these laborers that are doing this work and go and work. After all, in your letter of appointment, they said, and any other job assigned to you by your boss. And your boss asks you to go and join them. Do you expect your boss to now pay you separately for doing that one-off contract? It is part of your job. You have been paid for that time already. And so you were busy doing nothing. So the relevant cost for a permanent employment that has spare capacity is nil. So that's what you should take note. Once you see spare capacity, remember it's permanent employment that has that language. Now, when a permanent employee does not have spare capacity, we move to the next question. So, since there is no spare capacity, is overtime possible? Now, it is possible that overtime is possible. What do we mean by overtime? It means that you go to work, you resume work from 9 and you close by 6, and between 9 to 6, you were working. You don't have any spare capacity to maybe either play game or to rest. Maybe the only time you rested was to stretch and you took a 10 minutes break, which cannot be called spare capacity. Maybe you took a 10 minutes break. Now, you finished working by 6 o'clock and they say, we still have a one-off contract to do. Please, you are going far and the traffic is too much. Can you spend extra 2 hours joining them in doing the work? Now, what you have agreed with your employer is till 6 o'clock. So anything after 6 is not part of the contract. So he should be paying you overtime bonus. So that overtime is relevant because he has not bought that time. He is now trying to buy that time by asking you to come to work and spend beyond your normal official closing time. So If there is no spare capacity, if there's no spare capacity, but you think you can do overtime, overtime is relevant. Overtime can come in the form of going to work on weekends. If your job contract does not allow you to, does not include weekends, and they now say come on weekend, it's a form of overtime, you will be paid for that overtime. Now, assuming that overtime is not possible, what it means is that once you close by 6 o'clock, tell your boss, I have a class by 7 o'clock. I can't be here. I can't do overtime. Note that you didn't have spare capacity. You didn't have spare capacity. And your boss tells you, please spend another 2 hours. You say, no, I can't do that. No spare capacity. Or you come on Saturday. You say, no, sir, I can't afford to do Saturday because I also study on Saturday, or I engage in this activity on Saturday. No spare capacity. And that is genuine. What will happen? There is opportunity cost could happen. What is the opportunity cost here? Now, because that one-off contract is important to your organization, you may stop doing whatever you are doing right now to go and join them in doing that one-off contract. Now, mind you, you are not going to be paid because you stopped doing the job to go and join them there. You have been paid for that time that you are even using to do that one-off contract. But the problem is you have stopped something to do another thing. Now that thing you stopped doing is the opportunity cost. So let's say that you are producing bread. I don't know, I like bread a lot. You're producing bread, and they ask you to stop the production of bread for 3 hours and take that time to join them in producing cake for a one-off contract that somebody has ordered, and this order does not come every time. You find out that that's an opportunity cost. You will lose revenue. So that lost revenue that you will lose for not producing bread for that 3 hours is a relevant cost. That should be taken into consideration when determining the price. You must add that relevant cost to it. So if there is no spare capacity, either overtime or opportunity cost. So let's look at it again. In labor, the first thing you should be considering is the permanence of the labor you are bringing. Then, when that is sorted out, you'll be looking at spare capacity. If that is sorted out, you'll be looking at the possibility of overtime. If there is no overtime, then there should be opportunity cost. Let's look at one question here now. Example number 2. Augusta Chinenye Limited has been asked to quote a price for a one-off contract. The contract will be done in their 3 departments known as Department 1, Department 2, and Department 3. Now look at Department 1. The contract would require 200 hours of work in Department 1, where the workforce is paid 160 naira per hour for a fixed 40-hour work. There is currently spare labor capacity in Department 1, and there are no plans to reduce the size of the workforce. Department 2. The contract will require 100 hours of work in Department 2, where the workforce is paid 240 naira per hour. This department is currently working at full capacity. The company could ask the workforce to do overtime paid for at a normal rate per hour plus 50% overtime premium. Alternatively, the workforce could be diverted from other work that earn a contribution of 80 naira per hour. Now, Department 3. The contract will require 300 hours of work in Department 3, where the workforce is paid 240 naira per hour. Labor in this department is in short supply, and all the available time is currently spent making product Z, which earns the following contribution. Look at the sales price, 980. The labor is 2 hours per unit. It is significant that 2 hours per unit is stated there, because we are talking about labor. This is relevant cost of labor. Now look at the other variable cost, 300. When we add them together, the total variable cost is 780, and our contribution is 200 naira. Required. What is the relevant cost for the contract of labor in the 3 departments? So let's look at how our answers will be like. Okay. Now look at our answers here. The first question says, is the labor in permanent employment? Is it in permanent employment? So let's look at labor number 1, department number 1. They require 200 hours of work in department 1. Now they said where the workforce is paid 160 naira per hour. So that means there are some people already employed there. There are some people already employed there. And when you see the word here, fixed 40-hour week, the word here, fixed, can be replaced with guaranteed. That means they are paying them salary for the time that they use there. So they're not paying them hourly. So irrespective of these 200 hours that they're saying here, these people are paying fixed amount for their workers. So that means this is a permanent employment. So you see, the department in department 1 is in permanent employment, since they are paid a fixed amount for a guaranteed work week, whether they work or are idle. The question also says that the department has some spare capacity, idle time. Let's see where they say it. They say there is currently spare capacity, spare labor capacity in department 1. And there are no plans to reduce the size of the workforce in this department. What it means is that because they have spare capacity, they can all be called to move to that new project during their idle time to do it, because we have already paid for their idle time. And so if they can spare 200 hours that the contract is requiring during their idle time, fine. That is how they will fill their capacity. And so the relevant cost here is 0, because they have spare capacity. So whenever you see labor having spare capacity, relevant cost is nil. Let's get to department 2. Department 2 will require 100 hours of work. Now, they say the workforce here is paid 240 naira per hour. That means this is the rate they pay the workers there. They now said this department is currently working at full capacity. So capacity is the language for permanent employment. There are also people employed permanently. And when you hear capacity, either full capacity or half capacity or 30% capacity or spare capacity, that is the language for permanent employment. So what we'll say here is the department has some permanent staff there. So permanent employment is there. So we move to the next question. The next question we will talk about the permanency of the employment is if there is capacity, spare capacity. They now said there is full capacity. So there is no spare capacity. So if there is no spare capacity, the next question is the last question, which will be talking about if overtime is possible. Now, they said the company could ask the workforce to do overtime work paid for at a rate per hour plus 50% premium. So you see, these people go to work, they are working every time, and you ask them, come and do overtime now. So look at the option you have. Now, the department has no spare capacity. They are working at 100% full capacity, no idle time. Overtime is possible. Now, because they said overtime is possible, this means that they will be spent, okay, this means that the time that will be spent on the job and the overtime cost is relevant. So that's overtime that they will spend on the job and the overtime cost is relevant. So that is one thing here. Another alternative here was that the workforce could be diverted from other work that earn a contribution of 18 naira per hour. So you see, there are some people who are doing some less important work, so to speak, that will be giving them 18 naira per hour. So instead of asking people to do overtime, you can tell some people to stop whatever they are doing that is giving a contribution of 18 naira and come and do the job that I want us to do, this one-off contract. That means this 18 naira is relevant because that is a lost contribution. So what is the alternative that you will take? So look at how it is being dealt with here. Relevant cost, alternative number one. Maybe we are using overtime. What it means is that the work requires 100 hours. This is 100 hours for that job. Now the overtime that you are going to pay them is, they said normal pay is 240 plus 50% of this normal pay as overtime. So you're not going to just pay them 50% of it. You're going to pay them the normal money plus overtime. That is why they are working. So that means you have 100 hours plus this 240 plus times open a bracket 240 here plus half of 240, 120. So this gives you 360. 360 multiplied by 100, you have 36,000. This is one alternative. So you're asking, if you ask them to do overtime job, this is what the company is going to spend, favoring overtime. Now, assuming they said no, let's test the other option. Let's ask some people who are doing low productive work to be diverted to come and do this job. You are going to pay them 100 hours. They're going to spend 100 hours, fine. And you are going to pay them as if they are recruited to come and do this job as a temporary staff. So you are going to pay them 240 naira normally. You see, the same thing you did here, the job is normally paid 240, you pay them, but because they are spending overtime, you are going to pay them overtime. Here, you are paying them the job money, but there is no overtime. They are doing it within their allotted time. So the only thing we do here is that lost contribution. We have to charge that contribution lost to the project. So you have to add the 80 naira because you are going to lose 80 naira for 100 hours. So what you get here is 100 hours multiplied by 240 plus 80, which is 320, multiplied by 100 hours, you get 32,000 naira. So you ask yourself, if you are the company, if you are the HR, which will you propose to your company? You propose the one that will give you the lower costs, 32,000. So the cheaper of the two alternatives is alternative 2. Hence, no overtime will be paid. However, they will divert people to work from other departments to join department 2 in the job. That's not all. We'll go to department 3 and we'll consider what relevant cost is there. They said in department 3 that the contract will require 300 hours of work in department 3, where the workforce is being paid 214 naira per hour. That's beautiful. Labor in this department is in short supply. What does that mean? That you will need to recruit people. You will need to recruit people because they are in short supply. You will need to recruit temporary staff, which you will pay 240 naira per hour. Not only that, all the available time that is required spending it on product Z that will have to be stopped, this 200 naira per unit is the lost contribution. Now, for how many hours will they lose this contribution? If they are doing 2 hours for 1 unit, if they are doing 2 hours for 1 unit, and you have 30 hours of work that these people will come and join, that will mean that for every 2 hours, 1 unit will be produced. For every 2 hours, 1 unit will be produced. So if they spend 300 hours, that means they would have lost 150 units. So that will mean 300 divided by 2 will give you 150 units that will be lost. So when you multiply the 150 units by 200 naira per unit contribution, you get the lost contribution. So let's see how it's been done here. So we say the department has short supply of labor, hence they will need to recruit temporary staff for just this work. They will pay them 240 per hour, but they do not have the intent of employing temporary staff. Of course, even though they are in short supply, they didn't tell us that they're going to employ temporary staff. They only told us that they are in short supply. They didn't tell us they're going to employ, but that's an intention that can be created. But they said that they will stop making a product that will be using 300 hours. So opportunity cost is now coming in here. So when we say that they are temporary staff, so we have checked availability and the permanence of the labor is permanent labor. We've checked the capacity, they have no capacity. So we move to the last question. Is overtime possible? It appears that overtime is not possible. That is why they are using the opportunity cost method to see what to be done. They want to stop making product Z during the 300 hours. If they do, they will lose 150 units of Z. We've calculated it before, 300 hours per 2-hour labor hours per 1 unit. It means if they are doing 2 hours for 1 unit, how many units would have been lost in the 300 hours that will be used to diverted to this project? 150 units. So what we now need to do is 150 units that will be lost, multiply by the lost contribution will give me 30,000. So how do we calculate the relevant cost? These 300 hours, they will be paying them 240 naira as if they recruited people to come and do the job. That's the normal pay for the job, 72,000 naira. Then the lost contribution of 30,000 must be added. So you have a total of 102,000. And that's for Department 3. So you bring the total here, you say Department 1 is 0 because they have spare capacity and they can do the job in that department, so they're not paying them. Department 2, we saw that they did opportunity costs. Opportunity cost was done here instead of overtime. It was 32,000 naira. Then the last department just did here 102,000. We add them up together, we have 134,000. Now let's assume that this question that was given to us, question number 1 and question number 2, are for one question. That they test you relevant cost of material part A, relevant cost of labor part B, and they now tell you to find the total relevant cost. That will mean that you have to add your material cost and add your labor costs, and you will get your total relevant costs. Now, the main thing for doing relevant costs is to know the minimum costs that you can incur, or in fact, to know the minimum price that you can price your contract. Let's say, due to relevant costs, you find out that you're going to spend 5,000 naira as relevant costs. Now, there's a difference between relevant costs and total costs. Total cost, you are including fixed costs, both relevant and irrelevant. But relevant costs, you've picked those items that are relevant. You've identified what relevance means here. You've picked those items of relevance and you've come up with a figure. That answer you've gotten for relevant costs is the minimum costs or the minimum price you can give to your contract. If you charge anything below that, you'll be running at a loss. So we do minimum costs or relevant costs to know the very barest minimum of our contract price that will make us break even. So if somebody is trying to give us a contract, of course he's paying for plenty supply. He will not be paying the normal usual amount. He'll be paying something far lower. So he has offered you to give you this the amount I want to pay. You use a relevant cost technique to find out if that is a good bargain. So you see, it's a short-term decision-making process. One-off contract. You may not get that contract again. Somebody's coming here to do maybe a celebration of marriage anniversary. That does not happen every time. Maybe he's celebrating 5-year anniversary or 10-year anniversary, and you have asked you to supply me cake. And you're spending the time that you're supposed to do bread, to do cake for that person. And this is the amount the person says is going to pay for 1,000 pieces of cake. So you see that you are going to apply your relevant cost technique to handle such a situation. So far, so good. We've looked at some costs and we've classified them as relevant or non-relevant. We saw 5 costs that are relevant. We said that relevant costs are variable costs, they are opportunity costs, they are future costs, they are avoidable costs, and they are incremental. We saw some costs that are non-relevant. We call some of them fixed costs absorbed. We saw committed costs. We saw sunk costs, non-cash flow, and avoidable costs, unavoidable costs rather. So all of these, when you know this classification, it will be easy to know if this cost here, bringing this cost item is relevant or not. We've looked at relevant cost of material by answering 3 questions. The 3 questions again are, is this material available in store? If it is available, that means it's yes. That means ask the next question. If it is not available, it means you have to replace, you have to go and buy them. So the current market purchasing cost is relevant. Now, when you ask the question, the next question, is this material that is available, is it in constant use? If your answer is yes, it is in constant use, that means whenever you use it, somebody will be on queue to come and use it. So you have to replace. So the replacement cost becomes relevant. If it is not in constant use, you take it to the next question, which is it scarce in supply? If it is scarce, then that means, if it is scarce, that means it is either nil, because if it is not scarce, it is nil because you're not using it and it's not scarce. You have no opportunity cost about it, so it's just nil, or you have to dispose it. But if it is scarce, that means opportunity cost can come up. You can see alternative use for that scarce resource. We look at labor, and we said the 3 questions to ask is, the first one is about permanence of labor. Is the labor in permanent employment? If you answer yes, that means you move to the next question. If you answer no, it means you have to employ them specially for the project. Hourly rate is important. Now we go to the next question. It has to do with capacity. Are these permanent laborers working at full capacity, or do they have spare capacity? If they have spare capacity, it's nil. If they have no capacity, the next thing to ask is about if there is overtime possible. If it is possible, fine, overtime premium is relevant. If it is not possible, then opportunity cost is relevant. Let me look at some of the questions that may have been asked from this lecture. Okay. It appears the student did not ask any question. I take it that everything that was taught here is properly understood. Okay. It appears the student have left the class. So we'll rightfully end the class today. Until next time, when we'll have MI, then we'll meet again. That will be on Monday. Thank you so much for the time.
Hello? Prof, are you there?
Yes, I'm
here. I don't know if you can confirm it's not a network issue from the student end.
Okay. Anyway, even if it is a network issue, we cannot still retake the class because time is well spent. So,
all right.
So all we need to do is, if he has any question, he will ask me and I will get in touch with him. Then another way, you still get the videos too and watch. I will still get in touch with him.
No problem.
Thank you so much.